All right, let's see. Is this thing on? Hello. Good morning. Thank you guys so much for being the early birds. We don't like to share this little secret, but for those of you who show up for the breakfast portion of the event, you get like extra credit points towards the raffle gifts. So, you know, don't tell anybody else. My name is Lisa Gritzner, and I'm the chair of VICA, and I'm also the CEO of LG Strategies. But today I get to wear my VICA hat, and actually before we get going, I just wanted to publicly acknowledge and give a little round of applause and thanks to the LA City and LA County firefighters who are working so hard to keep all of us safe and keep the San Fernando Valley safe today. So sending good thoughts their way and hoping that they stay out of harm's way during some pretty challenging conditions. And thanks all of you who were able to make it here this morning, and hopefully not too many challenges with childcare. We should have just sent out a note to have you guys bring the kids here, because our volunteers from Granada Hills Charter School are having a hard time getting here because they didn't have school today. So we could have used, you know, some extra arms and legs here. This is the 31st annual Business Forecast Conference. So this started when I was not even born yet. I'd like to thank our Economic Forecast Breakfast sponsors this morning, and that's Bank of America and U.S. Bank. Thank you. And I'd like to thank our presenting sponsors, Wells Fargo and Southern California Gas Company this morning. SoCal Gas, always here. For more than 70 years, the Valley Industry and Commerce Association has been the leading advocate for San Fernando Valley business community, tirelessly advocating for the region's job creators, and many of you who are in this room today. We're glad you joined us today as we don our corrective lenses to see what 2020 might have in store. From sports and economic development to data security and elections, all of the issues our panelists discuss today are intertwined. Since 1988, VICA's Business Forecast Conference has brought leaders from across the business, political, and nonprofit communities to work through the challenges and opportunities the San Fernando Valley faces for the year ahead. I would like to introduce the moderator of our Economic Forecast Breakfast today from one of our breakfast sponsors, Kurt Fuess.
Correct.
Oh, I got it. Vice President of Global Commercial Banking for Bank of America, Merrill Lynch. Welcome, Kurt.
Thank you, Lisa. To get us started this morning, I want to make sure everybody sees that you have a survey on your table. VICA is asking if you guys could complete this at the end of breakfast. It'll only take you guys a couple minutes to do, and please hand that back to a VICA staff member or one of our ambassadors. That would be greatly appreciated. Now, as you guys can tell from the theme of the event, 2020 Vision Required, the goal is to look forward. We're glad you guys joined us today as we work to achieve this goal, which is really what business people do every day: work hard, create jobs, and try to succeed. But what direction is the economy going is always the question. The VICA Business Forecast Conference is one of the premier events in Southern California region with the best economists available. We bring together knowledgeable economists so that business leaders are given the information that will help prepare them for the future. Our speakers have prepared some important information for everyone. So let me get to the introductions of them. First, I'd like to introduce Sarah House, Director and Senior Economist for Wells Fargo Securities. She'll be giving us the national overview. Following Sarah will be Jeff Kravetz, Regional Investment Director for the Private Client Reserve of U.S. Bank. He will be giving us the economic view of California. And finally, Somjita Mitra, our economist for the local forecast. So I'd like to hand it over to Sarah right now.
Thank you. Well, good morning, everyone. I'm excited to be here with you and help kick things off. So when I look at the broader macroeconomic landscape and I look at the U.S. economy and the global economy, the old Chinese proverb, "May you live in interesting times," springs to mind. So right now we have the tightest labor market we've seen in 50 years. We have tame inflation. You have stock markets near all-time highs, and yet the Fed is cutting rates. That's because by a number of indications, we are pretty late into this cycle. And of course, there are a number of risks on the horizon. So we'll talk about some of these dynamics and what it means for the outlook and Fed policy. Now, before diving into my charts, I wanted to see how many of you think that we'll get a recession within the next 12 months here in the US? Okay. Now, there was a study about 2 months ago that came out from Boston University and Harvard Medical School saying optimists live longer. So just, for what it's worth as we go through this. All right, well then to look at our overall GDP forecast, you can see that at Wells Fargo, we are thinking that the US expansion will continue. We are not expecting a recession as our base case for the upcoming year, but we are seeing a significant slowdown in growth. So last year when we all gathered, I think really the dominant theme of what was going in the economy was that we had this tremendous fiscal stimulus, which was helping boost growth. Well, we were riding that wave, but now we've seen the fiscal stimulus fade, and so that's contributed to the slowdown in growth. But at the same time, of course, we have some pretty stark global headwinds, particularly when it comes to trade policy. And if you think about where a recession comes from, so it can come from some sort of imbalance in the economy, like too much debt somewhere. We see to some extent some debt buildup that we're watching in the corporate sector. Fiscal and federal debt is kind of its own beast. But the other area you can get a recession from is some sort of shock. And I think when we look at what are some of the potential shocks on the horizon or what are some of the most imminent risks, that's really where trade policy feeds into this. And so to give you our assumptions about what we're expecting for trade, because that does factor into where we see the economy going. So we think that we'll continue to see this trade war linger, as if we really want to address some of the underlying issues of really China's industrial structure and their policy, that's going to take some time to resolve. But at the same time, we don't see things escalating further from here, in part because we are beginning to see some pain already inflicted on the economy, and we think the administration is going to be cautious to inflict more pain, just given that we are headed into an election. Now, when we look at the overall impact from the trade war, so the direct costs to the US are very manageable. So this chart shows the share of goods that have been exposed, or the amount of goods that have been exposed to tariffs and that tariff rate. And you can see, though, that it all adds up to about $112 billion, even if you include the tariffs currently planned for December. Now, this is a $21 trillion economy, so $112 billion, it's nothing that's really gonna rock the boat directly. The problem is, though, of course, if you look at really the direction of travel of this chart, it's pretty much one way upward. So we started back in 2017. This was pretty targeted. Okay, laundry equipment, solar panels. But now, of course, we're looking at tariffs from everything we import from China. And with that escalation, it's added a lot of uncertainty to the outlook, where even as we've seen maybe some gestures here and there, that these questions surrounding trade policy and the fact that we're really beginning to reverse about 30 years of the global trading system is unwinding. And so while the direct macro impacts might not be that harmful to the US as a whole, so certainly challenging if you're a company in the crosshairs, but when we look at the uncertainty that this causes, that's the bigger risk and impediment to the outlook right now. So we've seen trade uncertainty climb to levels higher than we even saw when NAFTA was being drafted and implemented. And we're seeing that get passed through in terms of capital spending and capital spending plans. So capital spending plans are at about a 3-year low. Same thing with CEO confidence. And understandably, it's hard for businesses to plan if they don't know what their input costs are going to be or how competitive their goods are going to be selling into a foreign market if there's the potential of retaliatory tariffs. And so business investment is really where we've seen the weakness more recently, and we expect it to continue with business investment probably slightly negative over the next couple quarters. Now, we're also having knock-on effects in terms of the global growth environment. So this isn't just about the US and China, but as the US and China have pulled back on their investment plans, well, that affects capital goods production in Germany. That affects what's going on in Japan, South Korea. So we've really seen a broad slowdown in trade as well as global growth. So this chart looks at both global trade volumes as well as global industrial production, which is a good proxy for global growth. And when we look ahead to next year, we're probably only looking at about 3% in terms of global growth, which would be about the slowest pace since we've seen since the global financial crisis. Now, this is very closely linked to trade, but there are some other issues going on as well. So Europe's still kind of cleaning up from the auto emission scandal and some of the production challenges that that's caused. You still have Brexit looming over the UK. China was already undergoing a structural slowdown just as their economy matures. But this is really, but trade has really exacerbated that transition. So with the global backdrop having weakened, so not surprisingly, that's put undue pressure on the manufacturing sector. So if you look at the ISM indices, the manufacturing index is at a level consistent with a contraction in activity. But the more important line here is that darker one, the non-manufacturing. So that represents your service sector as well as mining and construction, and accounts for 88% of the US economy. So that's still growing, although we have seen that slow over the past year and move closer to that 50 break-even line. And so that does raise some recession risk, that you are seeing some spillovers in where this isn't just a manufacturing specific issue anymore. Now, before diving into foxholes, so one of the reasons why we're not expecting a recession is if you look at the state of US households and the consumer. So consumer spending is the largest segment of the economy, accounts for about 70% of GDP. And when you look at the fundamentals here, consumers remain in really good shape right now. So we've seen households delever. If you look at monthly debt service or even even broader monthly financial obligations as a share of income, you can see that that's at some of the lowest levels we've seen since the 1980s. The saving rate right now is about twice as high as what we saw in the 2000s. So households have a lot of cushion in their budgets and wherewithal to continue on spending. As far as the inflation impacts from tariffs, now that we're seeing them pass on to more consumer goods, potentially derailing spending, well, the effects there remain pretty minimal. So we think even if you get those remaining consumer goods tariffs going into effect in December, it's only going to add about 1/10 or 2/10 to inflation. And while we've seen goods inflation pick up, so that's this kind of orangey line at the bottom of that chart, really if you look at overall inflation, it tends to track services much more closely, because most of our spending is on services. So think of some of your biggest expenses. It's probably housing, healthcare. And so when we look at the overall pass-through to broader consumer purchasing power of tariffs, it remains pretty small, so not going to significantly knock off consumer spending. Now, while consumers have the means to spend, the question is, do they have the will, given this more fraught environment that we've seen? So we've seen confidence really kind of move within a range over the past year. So we had a lot of financial market volatility late December, you had the government shutdown, trade war flaring up in the middle of the year, more financial volatility, now you have impeachment, now you have higher gas prices, which are inversely correlated with confidence. And so the question is, does this hit to confidence? Does that become a headwind to consumer spending? And the fact that you're no longer seeing confidence rise is a signal to us that you are going to see a slowdown in discretionary spending. So that confidence does tend to feed through into consumers' action. So looking for some moderation in consumer spending. But we're not expecting spending to fall off a cliff, and that's because, as I mentioned earlier, the labor market is really tight right now. So not only do you have the unemployment rate at a 50-year low, but you have wages rising, especially in lower wage industries. So you're really seeing the base of spending begin to broaden again. We're not just relying on upper income households to fuel this expansion and to fuel spending, but you're seeing some of the strongest income growth in some lower income households who do have a higher propensity to spend. Now, when we look ahead, though, at the labor market, we are seeing some signs of a slowdown there. So we've already seen private sector hiring slow over the past few months, and job openings have moved lower as well, suggesting that demand for labor is weakening as you have seen more growth headwinds. But we expect that you should still continue to see some pretty decent gains, but it does point to slower income growth and therefore some slowdown in spending. So fundamentals remain good in terms of the consumer space, although we are expecting some moderation in spend. Now, another potential headwind for the outlook and a sign that we're late cycle is that we're seeing more pressure on corporate profit margins. So that's been impacted by these higher labor costs, but also if you're a company that faces those tariffs, you're seeing some pressure on margins there. So that's part of the reason why inflation isn't about to take off with these tariffs. It's because companies are absorbing some of that. And you can see from the level of profit margins, they have some room, thanks to, in part thanks to the tax cuts as well that we saw last year. But as you get more pressure on those profit margins, it does put some pressure on debt service where corporations have taken on a lot of debt, and does suggest that we will see probably some slower capital investment from that front as well, not just the uncertainty angle. So what does the Fed do in this environment? Well, they've already cut rates twice, and we think that they're probably not done yet in terms of this mini easing cycle. So we are expecting them to cut next week, and then probably once more in early 2020, as we see some of the actual economic data come in weaker, where you have GDP numbers of roughly 1.5% rolling in. The Fed's going to have to respond to that. And so when you look at, okay, how much might that help the economy, given that if trade's the biggest question mark hanging over and the Fed doesn't set trade policy and they're not really the source of unease of this, how does that help? Well, it can offset other sectors. So maybe it can't provide that settled rule book, but in terms of helping the housing market, where we've seen refinances pick up again, we've also seen home sales rise. Businesses have refinanced debt, which is taking some pressure off their balance sheet. So you can get offsets in terms of that, even if it can't fully solve for the trade question. The other thing that Fed easing can do is it can help financial conditions. So I think in some ways, one of the more ominous signs of late cycle that we've seen has been the inverted yield curve, or at least parts of it having been inverted at least for a time. I'd caution in reading too much into that yield curve in terms of the lead time can vary pretty dramatically of when it inverts and you actually see a recession. We've also seen inversions that haven't been followed by a recession. And the Fed over this cycle has actively tried to push down long-term rates. And so in some ways, you've seen the yield curve invert even earlier, and it wouldn't even be inverted if it wasn't for quantitative easing. But if you step back from the yield curve, it does signal that investors to some degree are on edge. But if you look at broader financial conditions, so not just yields at different maturities, but also things like credit spreads, bank lending conditions, you see that we have seen some tightening in financial conditions over this past year. But if you compare it to conditions, pre-crisis norms, so we're still roughly in line with historic averages. And you still have financial conditions easier than what we're seeing in 2015 and 2016, when we also saw the economy slow, but we didn't see it fall outright into a recession. So you still have credit flowing in the economy, and your biggest segment of spending, consumers, are doing pretty well in terms of their positions. And so between those two factors, we think that as we look ahead to these challenges, that the US economy can grind out this period. And even though we are late cycle, that we can continue to see this expansion roll on, that just because we're now the longest expansion, we don't actually have, expansions don't die of old age, but we can move through this period and continue to grow. So I will go ahead and stop there and turn it over to Jeff to talk about the California economy.
All right, it's great to be back here. I think this is my 5th year doing the California economy. And this is actually one of my favorite events because I love the California economy. It is one of the most dynamic economies in the world. And we at US Bank believes that California is going to continue to lead the nation with regard to growth and innovation. But you know what? We must recognize that California is not without its issues, right? High housing costs, rising income inequality, and even natural disasters like fires. So I'm going to jump right in, and we're going to see how California is doing. Now, I know you've seen this slide before. It's one of my favorite slides. It puts California up on the top 10 economies in the world with regard to GDP. So California weighs in at number 5, right behind Germany. California has $3 trillion in GDP. So California is really unrivaled when it comes to innovation and when it comes to wealth creation. This is a state that companies are moving to if they want to turn dreams into reality with regard to technology, life sciences, and with regard to wealth creation. If you look at the California publicly listed companies over the last decade, their return is double the S&P 500. So the state must be doing something right. Let's talk about GDP trend and growth over the years. And this goes back to before the Great Recession. And you can see that California has done a good job with GDP growth. GDP growth peaked in 2000 and looks like 15 or 16 there at 4.5%. The average for the past 5 years is about 3.5%. Now, the GDP of California is going to downshift into about 3% for this year and next year. And you know what? That probably doesn't sound very sexy or exciting, but for the economists up here, that's pretty good because the national economy is only going to grow at about 2%. So some of the industries which are driving California, and the reason why California is such a strong economy is it's very diverse, right? You've got trade, technology, tourism, entertainment, real estate, and agriculture, and those are just a few. So I'm also, in this presentation, going to comment on a few of those. I'm going to talk about the LA ports and trade, and I'm going to talk about technology in Silicon Valley, and I'm also going to talk about entertainment since we're here in Universal City. I've got to talk about unemployment because there's an unusual statistic here that maybe you don't know. This is unemployment for California versus the national average going back several decades. And what you see is that on average, unemployment in California is about 1% higher than the national average. Although recently, the state has really done a great job of closing that gap. And we're at a historic low in California, 4% unemployment versus the national average at 3.5. So you're probably saying, Jeff, you just told me how great the economy is. How come we have a chart like this? The reason is because the California economy is a two-stage economy. Along the coast, the large cities in the Bay Area, LA, Orange County, San Diego, unemployment is very low. The labor market's tight, but then when you go inland, you've got rural and agricultural areas where unemployment is high. Put them together and you have a higher unemployment rate. What's not on this, unfortunately, is a real human issue, and that's rising poverty. When you take into consideration the high cost of housing, unfortunately, California has the highest poverty rate in the nation. So a very wealthy state, but also a state with rising poverty. So an issue for local governments and businesses to address. Now, I'm a finance guy, so when I say, what's the health of the California economy, I look to capital markets. What do they say? So California has almost 500 municipalities. All of those municipalities issue debt for water, power, sewer, housing, schools. And this chart here is the spread between California debt, municipal debt, and AAA average national municipal debt. And at the height of the Great Recession, 1.5%. So in our world, in the capital market world, in the muni market, that's really high. Now it's down to 0. And the state has a AA minus rating according to S&P. And I do want to give a shout out this morning to the state treasurer, Fiona Ma, because the state is doing a great job with its finances. A $21 billion surplus. And most recently, her office refinanced debt. And it's going to save the state $1.4 billion over the life of the debt. Now, there's another thing that you need to know about when it comes to California finances, is this state is very levered to wealthy people. The top 1% in California, income earners, are responsible for 46% of all personal income tax. So when the stock market is good and when the real estate market is good, the state coffers are full. But when we have a downturn, California feels it more than other states. This is a chart on where the job growth is. So it's year-over-year job growth, and the average in California is 2%. But what I'm interested in is what are the industries which are really growing and the ones which are lagging. So the one on this chart which is really growing is construction, right? Double the average at 4%. So we all know that there's a huge amount of construction. There's a shortage of housing. Commercial projects are happening all over the state. You'd be surprised that one of the hottest markets is actually the warehouse market because of the rise of e-commerce. And then one of the ones which is not growing, but the state's trying to work on that, is manufacturing. Manufacturing is only growing at half the state average. And some of the things that the state is doing is they're providing incentives for businesses to do more manufacturing. The state provided incentives for Northrop Grumman and Tesla to provide 8,500 jobs, and then also Edward Life Sciences at Irvine, California. They got a grant for $20 million to spur innovation in manufacturing. We're here in LA County, so I would be remiss if I didn't talk about the ports. The Port of Los Angeles and the Port of Long Beach are major economic contributors to this region. And it's not just the ports. There's a whole infrastructure that's built up around the ports. When goods come off of ships, they're loaded onto trucks and rail, and they go into the Inland Empire, San Bernardino, Riverside County. There's over 2 billion square feet of warehouse space there. So what's going on with the ports these days? You'd actually be surprised that port volume is up and close to record highs. So what's driving that? We're at ground zero here for the trade war, and 60% of all the goods that come in are from China. So importers are front-loading shipments into California to get ahead of tariffs, because by the end of the year, basically all the goods from China, unless anything changes, is going to have a 10 to 25% tariff. So volumes coming in are high, volumes going out are low because of tariffs on agricultural goods. Now, one of the crown jewels of California is technology in Silicon Valley. This is a state or place where dreams really do become reality. And that happens through venture capital. Some of the most wealthy or highest market cap companies in the world are here in California. You've heard of the FANG stocks, right? Facebook, Apple, Netflix, Google, they all started out right here as venture capital deals. So venture capital takes an idea, provides funding to make it a private company, and then take that company public. So this shows the deals, California venture capital deals, and the total amount raised over the past years. And in the past decade, California has raised $330 billion in venture capital, and that's about half of the venture capital in the United States. So a very strong and thriving ecosystem when it comes to raising capital for new businesses. Now we're here in Universal City, so I want to talk about entertainment, which is also another uniquely Californian industry. And I could talk about film, but I want to talk about television. And the slide says, Hollywood, the future is digital. What's going on now in entertainment is really a revolution. And companies like Netflix, Amazon, and Hulu are changing the way we spend our entertainment day. So you can see this is a chart of the number of live-action scripted series over the years. And the most recent data point, 467. All the growth there is from digital. And digital is big money. To do a scripted series, a live-action, high quality, could be $100 million for the series. And Netflix alone this year is going to spend $15 billion on original content. But you know what's great is that all filters down into the economy. And the LA studios, the sets, they're at capacity. And that contributes about $7 billion to the local economy. So this is something to really keep your eye on, and something that California is really an innovator at. Now, I have to talk about the high cost of housing because it creates a lot of issues and stress for Californians. And these are building permits, single-family building home permits, and also multifamily going back several years. And you can see before the Great Recession, peaking at around 200,000, we've recovered to about 100,000. But the state house really wants to expand that to 500,000 a year. That's what we really need to get things moving. And it's very difficult to build here because of environmental issues and zoning issues. And the state's trying to reform some of those laws and make it easier to build multifamily and single-family homes. So housing is a big issue. And the one upshot of this is that a lot of people from California are moving to places like where I live in Arizona, Nevada, even Texas, where the cost of housing is much less. All right, I got to wrap it up here because I want to give time to my colleague to talk about the local economy. So to wrap it up on California, California is going to continue to lead the nation with regard to GDP growth, right? California is a diverse economy: trade, technology, tourism, entertainment, real estate, agriculture. All those I mentioned really power the economy. But housing affordability is really one of the big issues that's causing net migration out of the state. But finally, despite all these problems, we believe that California is going to continue to lead the nation in economic growth and innovation because it's still a state where people move to really turn dreams into economic reality. And I wouldn't be surprised if I come back here in a few years and we're above Germany. So I'm going to turn it over to my colleague, and she's going to talk about the local economy. Yeah.
Good morning, everyone. This VICA Economic and Business Forecast Conference is one of my favorite events every year, and I'm absolutely thrilled to be here to speak to you a little bit about what we see happening in our local economy, at least through the end of 2020, using our 2020 Vision Required lens. So Albert Einstein said, "I never think of the future, it comes soon enough." But as my colleagues would say, we economists spend a considerable amount of time thinking about the future and what we can do to keep the economy growing and thriving, especially in some uncertain times. So Los Angeles County as a whole is the 19th largest economy in the world. We have a population of just over 10 million people and a workforce of just over 5 million. So what drives Los Angeles actually drives the rest of the state, which actually drives the rest of the country. So it's critically important that we understand what's driving the economy locally. So looking ahead through 2020, we are going to see our GDP is going to continue to grow at 2.7%. Unemployment is going to fall to 4.3%. Now, our local unemployment rate is a little bit higher than the rest of the state, which is a little bit higher than the rest of the country, and that's because we were hit particularly hard by the Great Recession. So our recovery is taking just a little bit longer. But we are seeing historic low rates of unemployment. And we are at what we consider full employment, which is where anybody who wants a job has a job. Now, I'll talk a little bit more about if it's the kind of job that they can have to support themselves and their families. And for the first time in probably several decades, we're starting to see some personal income growth. And we're starting to see our personal income grow to about 2.1%. And this is due to the fact that our economy is continuing to grow and continue to add jobs. And employers really have to start paying more to attract and retain quality workers. So that's very positive news for people working in our local economy. So let's talk a little bit about the jobs that we're forecasting to add in our by industry in Los Angeles through the end of 2020. So you can see that the largest job growth is going to be in professional and business services, leisure and hospitality, education and healthcare services. Now I'm going to touch a little bit about each one. Professional and business services are really the ones, most of these jobs are in administrative services. 40% of the jobs are considered temp jobs. Now, if you are a temp worker, then there's a lot of uncertainty about your paychecks from week to week, and that affects how you're going to be spending in the local economy. But the growth in the temp industry is really a consequence of what happened during the Great Recession, and companies have a long memory, and they're really afraid that it's expensive to hire somebody and it's expensive to lay them off. So the way that they are circumventing that and keeping their businesses growing is by using a lot of temp labor. However, if you're a temp worker, you tend not to spend the same because you're worried about if you're going to get a paycheck week to week. The next largest sector of job growth for us, obviously, is leisure and hospitality. We're the center of entertainment, the center of tourism in Los Angeles. However, most of the jobs that are being added in this industry are food service and food prep workers. Now, these are jobs that don't require a high school degree and pay about maybe $20,000 a year. These are not considered full-time jobs. So these are jobs that we're adding. Education and healthcare is a critically important industry for us as our population is growing and aging. However, a lot of these jobs are actually in-home healthcare workers. Now, in-home healthcare workers is a growing field for us. Unfortunately, in-home healthcare workers also don't require a high school degree and also pay about $18,000 to $22,000 a year. So these are some concerns for us. So a little bit more about what are the types of jobs that we're adding. I said that we are adding jobs. Our economy is continuing to grow and thrive. So let's look a little bit about the types of jobs that we're adding. Now, this looks at the total number of jobs that are being added in our region over the next through the end of 2020, compared to the MIT living wage. Now, the MIT has calculated what an adult person working full-time will need to be able to live and support themselves in a region. Now, in LA, this is considered just about $30,000 a year. I happen to think that's not enough money. But if you look at this chart, half the jobs that are being added in our region are actually paying less than the MIT living wage. Only about 2 jobs, registered nurses and general and operation managers, pay almost 6 figures and only are going to add about 8,000 jobs in our region over the next 2 years. Another thing to look at is the education and experience requirements of most of the job openings. Almost 40% of the jobs that we're going to be adding in our region over the next few years don't require a high school degree and don't require any experience. Another 30% only require a high school degree. Now, why does this matter for us? Is because your earnings potential, your lifetime earnings potential, really depends on your level of education. Somebody who has less than a high school degree makes on average $50,000 a year less than someone with a graduate or professional degree. This matters in terms of your spending and in the local economy. It matters about your ability to partake in the local goods and services and entertainment and living, and all of that is affected by your earnings potential. So this is very concerning for us, considering that 70% of the jobs that we're adding to our region require a high school degree or less. So what does this all mean for us? We're adding jobs, our GDP is continuing to grow, we're starting to see personal income rise. So that's all good news. We're working, but there are some warning signs for us. Recently, a record 7 million Americans have said to be 90 days or more behind on their auto loan payments. A growing number of Americans have more credit card debt than they have savings. And the government shutdown that happened at the beginning of this year really highlighted a really critical issue for us. 3/4 of US workers live paycheck to paycheck. And if you look at some statistics, most households wouldn't even be able to cover a $400 emergency. Now that's really a warning sign for how stable our economy is moving forward. And as my colleagues had mentioned, some of the critical issues for us, housing. So if I had a sound effect right now, it would be dun, 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 because really housing is one of the most important issues for us because it is affecting and constraining our economic growth moving forward. In LA County, only about 30% of people who can live here can afford to buy a home. The median household income required to buy a home in LA County is about $105,000. Now, if you remember the slide I showed you a few slides ago about the earnings of the workers that are adding to our region, half of those workers earn less than $30,000 a year. So how will they ever be able to, can they ever afford to buy? The bottom third of workers in LA County would have to spend the equivalent of 84% of their take-home pay on rent, or on buying a home. The middle third would have to spend the equivalent of 40% of their pay. and the top third would spend about 30%, which is the national average. So what happens if you can't afford to buy? You're going to rent. And in LA County, median income earners have to spend almost 50% of their income on rental housing, which translates to about $37,000 a year. Now, what this means is that most people who live in LA are considered rent burdened when they're spending almost 50% or more of their take-home pay on rent. And then if they're spending their money on rent, they're not spending their money on food, medical care, schooling, anything else that's required to really sustain themselves and keep growing. And that really affects the businesses and, that are providing the goods and services to their friends and neighbors and their ability to also keep growing if they're spending all their money on rent. Lower income earners actually suffer even more. The bottom third of earners in Los Angeles County would have to spend over 120% of their pay on rent. And that's obviously impossible. So what they do is that they double, triple, quadruple up in housing, or they move further and further out of the area. Now, there comes a tipping point for people and their ability to want to drive into LA to take these low-wage jobs. So after a while, they may choose and opt not to come into LA for these job opportunities. And why is housing so important? California is on its way to becoming a majority renter state. We're going to be the majority renter state by 2025. Southern California, cities in Los Angeles, the majority of our larger cities are already majority renter cities. And home ownership is the largest source of wealth for the middle class. Without that investment in your home, you're less likely to be as invested in your local community as well, and that affects us. Business location decisions are affected by housing. If businesses worry about being able to attract and retain quality workers or being able to have enough customers, they may choose not to stay in LA or they may choose to leave LA. Quality of life issues, if you're spending so much money on your rent or your mortgage, you're not spending as much on anything else. People are starting to move out of Los Angeles and even out of California. Over the last 10 years, 6 million people out-migrated to other states in the country. Only about 5 million moved in. We've lost people across all demographics except for one. The only demographic that has seen movement into LA or into California are those who earn more than $100,000 a year with graduate or professional degrees. Now, housing, why is this important for us? It's because it's a constraint on economic growth moving forward. So I'm going to really quickly talk about San Fernando Valley. So San Fernando Valley, this is the top industries by employee count. Over 1/4 of employees in the finance and insurance industry of the county is located here. San Fernando Valley also employs about 1/4 of all people in information and construction industries. These are both growth industries for the county. And San Fernando Valley provides 18% of all countywide employment. And then the top businesses, again, construction businesses are a lot located in San Fernando Valley. It also makes up 20% of all the arts, entertainment, and recreation industries, which is really important for us, and is home to over 100,000 retail trade businesses, 20% of all retail trade businesses in the county. So I'm not going to spend too much time talking about trade disputes. I think you've heard a lot that is very important. Just really quickly, I wanted to touch on a couple things. So every 1% increase in tariffs leads to a 6% decrease in imports. And as Jeffrey mentioned, this is important because we have the two largest ports in the country with the Port of Long Beach and the Port of Los Angeles. Now, this slide's a little bit hard to read, but it shows that we are a net importer of foreign goods, and we export only about 2.5 trillion. Now, the one thing to note about this is that we do import more of manufactured goods, finished goods, but we are a net exporter of service-based and knowledge-based industries. We have about an $800 million national surplus in those knowledge-based industries. So that is something that we can keep focusing on. We can keep growing in terms of software, in terms of education, in terms of information systems, that we can really grow and thrive regardless of what's happening with the rest of the market in terms of uncertainty. So this is really, at the time of this slide, things might have changed already. Every day, things seem to change in how we are looking at trade and tariff issues. So this just looks really quickly at how some of the latest challenges that we're having. And one of the things I wanted to note is that regardless of what's happening with the United States and China, regardless of what's happening with the United States and the UK, Australia, India, some of these growing markets, these countries are working together on other issues. So a lot of times we might not be as part of the conversation, we might not be leading the conversation because they're working together because they can't really wait on deciding what the United States is going to do. So that's something that we have to be careful of. We're kind of losing a little bit of our leading position in terms of really driving the conversation on some really critically important issues. So I wanted to quickly touch upon the R word. I know a few people raised their hands about when they thought they saw a recession happening. And one of the things is that recessions can almost be a self-fulfilling prophecy. If you worry about a recession, if you start fearing a recession, it really affects how you're spending in your businesses and in your personal lives, and that creates a ricochet effect in the rest of the economy. So a lot of times, recessions tend to be a consequence of some people fearing a recession actually happening. So just really quickly, some signs of a recession: the inversion of the yield curve, a major sector becomes unbalanced. This is what happened in the Great Recession, in the housing bubble. Consumer debt is, but one thing to focus on the consumer debt now is a lot of this is focused in, concentrated in student debt, student loan debt, and that cannot be forgiven in bankruptcy. So what are some of the signs of that? It doesn't exist anymore. Corporate debt, if it becomes too much, again, businesses have a long memory, and they're still recovering from the Great Recession, so they are pretty constrained in how much debt they're taking on now. We're not seeing a lot of overbuilding in construction. Again, maybe we're not building enough housing is really a result. Restrictive financial markets, I think we're really committed to keeping our inflation rates low now. The one thing that we can't actually control, and that might affect our economy, is a major exogenous shock from outside our economy. That includes war in the Middle East, a slowdown in China's economy, and a fallout from Brexit. These are things that can affect our economy, and we really have very little say and very little control over. So can you ever really prepare for a recession? You don't know how long, when it's coming, you don't know how long it's going to last, how strong it's going to be. But there's some things you could probably do: collect and leverage data, communicate with one another, anticipate new revenue streams. Like I said, one of the things for us in terms of trade is trade surplus in knowledge-based industries, so focusing on how you can leverage that, and maximizing today's revenue, right, and keeping that strong and growing. So our economic fundamentals, really through the end of 2020, are strong and steady and likely to continue. So that is really great news for all of us. So in conclusion, our economic growth is going to continue. We're going to continue to add jobs. Unemployment is going to continue to fall a little bit more. Personal income is going to continue to rise. However, we want to caution, there's a critical housing shortage in Los Angeles and in the rest of the state. Our economic prosperity is not benefiting all. A lot of the jobs that are being created are really low-wage jobs. We're starting to, obviously, with the fires that are affecting our community today, extreme weather and climate issues are becoming more and more prevalent. And of course, political gridlock, especially between the state and the federal administration. Thank you so much.
All right, we have a few minutes for Q&A. We're going to open this up to the audience. I think we might have a microphone. Okay, we got a microphone over there. To get us started, I'd love to hear maybe a little bit more about what's going on with the middle class. It's probably more questions for Somjita and Jeff. I'm kind of hearing that the middle class is hollowing out of California, out of San Fernando Valley, and kind of love to hear your take on that and what you guys think about that.
You want to take it?
Yeah, go ahead.
So yes, this is obviously a concern. We are starting to see an increasingly bifurcated economy. We have a lot of concentration of really high millionaires. That's when housing is, multi-million-dollar housing is being bought by cash from somebody. We're also seeing, obviously, a lot of people are on the lower earning section. And then the thing with this is that people move in and out of economic spheres. And so we are seeing that happening. So people who would probably be considered the middle class, they're trying to get higher earners and moving into the 1%. And so that is changing. So in terms of people moving out of the area in middle class, I'm not seeing it as much as they're moving up into an economic sphere. But the challenge for us, obviously, is the enormously large percentage of our friends and neighbors that are low-income earners. And they are not seeing as much upward mobility as we would like, and that is a concern for us.
Very good. Any questions in the audience yet?
Yeah.
I've got a question right here. Here, one moment, there's a mic coming.
Thank you. I'm Bob Rodine. Sarah, you commented on issues that could be driving the economy from a directional standpoint. I didn't see a slide that depicted the impact of social psychological factors, and I suppose that would include the impending election. To what extent is that a major driver in what we're seeing in the economy through the end of 2020?
So I think you certainly are seeing areas that that psychology is playing into the current environment. I think the uncertainty that we're seeing, the hit to confidence, both business and consumer, is certainly playing into this, where it does bring up the potential that perhaps one of the greatest risks of all is what Somjita mentioned too, is that we talk ourselves into a recession. As far as the election goes and how that plays into the outlook, so there's been some arguments that, okay, all this uncertainty surrounding two parties who are right now very far apart on policy and tough for businesses to plan in that environment could cause businesses to pull back, where they don't know how policy is going to look in this time next year. But then also on the other hand, okay, does the current administration try to gin up growth a little bit more, because how the economy is doing is still one of the biggest deciding factors and has been proven time and again to be a good indicator of how the election is going to pan out. So we've looked at this, and actually you don't have a statistically different performance in the economy in an election year. So it doesn't seem like uncertainty is a big headwind to growth, but at the same time, it doesn't really seem that you do see a significant bounce ahead of time. 2016 was interesting because that was actually somewhat of the opposite, where you did see slower growth in 2016, and then you saw things really take off in 2017. And so that might be impacting how some people think. But historically, you actually haven't seen that much of a change. And that's because we always have some degree of uncertainty. And even if you could tell me who the Democratic candidate would be today, it's hard to say, okay, well, what's Congress going to look like? So it's one of the benefits about our system is policy does tend to move slowly, even if there is a lot of chatter about this or that. It's hard to get sweeping reform done in any way to the full extent of any particular party.
We have a question right here.
My question has to do with the income inequality issues. VICA has been very supportive on housing in terms of moving housing, but typically our members have not been supportive of increased minimum wage and other kinds of forced wage issues. And I'm just wondering what your view is of how we move on income inequality, given the current gap and the statistics you showed showing the growth of jobs primarily in the less than livable wage area?
Well, I think that's a great question, and I know local governments or governments tend trying to, like you said, implement something that they think is going to try to help with the minimum wage increase or other decisions. The one thing I think is that it's really a consequence of a strong, thriving economy, where now we actually are starting to see more job openings than people actually looking for jobs. So as a consequence of that, companies are forced to pay more than they may have been wanting to, because they want to actually attract and retain those quality workers who maybe for the first time in decades have a lot of choices about where they want to go and where they want to work. So I think as an offshoot of that is that that's a positive sign for us, and that has, the government has no role in that. That's just really a consequence of the economy. Now, the thing is that is really for the productive, higher earning workers. For the lower income workers, unfortunately, the wage growth we've seen has stayed relatively stagnant for them for the last few decades, regardless of that. And I think that one of the things is really to encourage education for workers, not necessarily maybe a 4-year degree, but a lot of certificates or 2-year degrees, a lot of technical skills that really are going to help them get the skills for some of these jobs that require the workers to pay more. So I think instead of just focusing on the pay side, I think it's also maybe looking at the education side of it and having workers get more educated with the skills that the businesses need.
Yeah. I think we have one more question in the back.
Great information, thank you. What do you see as the impact of what you just reported on the stock market from a perspective of local companies, California companies, and the national market?
Yeah, that's a great question. As I travel around the West, a lot of our clients are very nervous about the stock market. The stock market is an all-time, or close to an all-time high. So they're nervous because of trade, the lagging effects of tax reform, just uncertainty with the slowdown. And Sarah, I think mentioned it. If businesses start slowing down, start spending less on capital expenditures, they get nervous. You can actually push yourself into a recession. But the consumer is really what drives the economy. The consumer is about 70% of the economy. So the question is, how does all this uncertainty translate into the stock market? And surprisingly, a lot of these issues have been a non-factor for the stock market. And what's really driving the stock market is Fed and Fed policy. And to cite a pretty strong example, is the Fed last year, they were raising rates. And they probably overdid it in December. The bond market said, whoa, we're not going to have any of that. We don't see inflation being that high, the economy is weakening. And you saw the stock market in December have one of the worst Decembers, since I think the Depression. And then what happened this year? The Fed is lowering rates. They've lowered twice. They're going to probably lower again. And that has really provided a lot of lift to the stock market and investor sentiment. So I think as long as the Fed is supportive and accommodative to markets, that's going to be a very good, a positive to the stock market. It's also a positive even to emerging markets when rates are low. But we do have to recognize that we are late in this cycle. But I think that they don't die of an old age. They typically die when when they see ramping inflation and the Fed raising rates. And we just don't see that. So the bottom line is there's probably going to be a lot more volatility in the stock market. But overall, we do favor stocks over bonds and still believe that there's room for the market to move up.
We have time for one more question.
I can just yell.
We can repeat back.
My name is Charles Crumpley. I'm wondering about the effect of AB5 on the economy. Thank you. I'm wondering about the effect of AB5 on the economy. The loss of independent contractors throughout the state. There's a fear, perhaps overblown, but I think a fear that the gig economy will be killed as a result. And so I'm just wondering if you have any thoughts on how that might have, the gig economy, of course, is so important to Los Angeles. So I'm just wondering if you have any thoughts on that.
So I know part of the reason with that was like identifying people as employees for Uber and Lyft and things like that in terms of the service, in terms of how they're getting their benefits instead of being an independent contractor. I'm not sure how that's going to play out. I know Uber is fighting back on that, so there might be a couple more years of this push and pull from it. I know a lot of Uber drivers tend to want to have the flexibility of being an independent contractor. They would require checking in. They would have to maybe work a certain number of hours, and that really changes the reason that they joined this gig economy. If you want me to answer about how that's going to affect the economy, I haven't seen the gig economy so far, unless has been a supplemental income for workers. They have not actually replaced their current income with a gig work, and so I don't see that changing, regardless of how they are identified as an employee or as a contractor. I actually might see that changing. People might not opt into becoming an Uber driver if they have to kind of buy into the system. So, yeah. Anything you want to add?
I think that's all the time we have for questions right now.
It's a tough one.
Yeah.
Please join me in giving a round of applause to our economists.
You did it, man. All right. You did it.
How did I answer that?
Thank you for joining us today. Some housekeeping items real quickly. Blue survey, ladies and gentlemen. You see it on your table, and I don't see it in anybody's hands. Well, Vika needs to get this done from you, and please turn that into to your staff member. Additionally, there is a raffle. You guys have all been handed out one of these cards. The bingo cards, excuse me, my apologies. You received a registration. You can, visit all the booths, and every booth has a stamp. This will give you a chance to win one of 2 pairs of round-trip tickets on Southwest Airlines, or 4 tickets to Magic Mountain, or signed football with the LA Rams. Breakout sessions begin at 9:30. You have about 15 minutes to visit all those amazing booths in the foyer, and I encourage you to do that. Once again, one more round of applause for our economist. Thank you for showing up.